Greetings, market rebels. Welcome to this week's sector situation. It is Sunday, September 10th, 2023. It's a little bit after noon here on the East Coast. I'm Wayne, and I'm going to get things rolling here for us so we can wrap things up on the videos for the week. Kind of a long macro measure. Here's our trusty disclaimer, by the way. And here is our trusty intellectual property rights notice. And it looks like actually looks like it's somehow I'm getting the wrong screen. It's not sharing the proper screen here. Let me see if I can fix that there. I don't know why my screen number shifted there. So sorry about that. And then finally, we are going to move on to the okay, there it is. This is the macro measure I was about to mention. This is just this week's stream. There's a lot of stuff on there, but just to give you an idea, this is what we covered there, just for the record, because I think that's usually the more important video. And on that note, let's stop the share and let's get that out of the way. And then we'll talk about the charts and on the sectors, which is what the whole point of this is, really, and just other comments about sectors. Naturally. So I'll start out with my grid of 12 that we typically start with. And what I was getting to in my comments earlier about macro measure was it took a long time to really explain that I don't think there's a really strong lean to be had at the moment. And unfortunately, that's also the case in the sectors. And it's really staring us right in the face. And excuse me. And I think that's because let's look at just a few, right? So we'll look at financials, which is an important sector. And those are between a recent swing high and a recent swing low. And so when you look at this and you look at this sort of intermediate term trend of the price structure, you're making lower highs and lower lows overall. But could this end up here, right? What we saw last week, could this be a little cluster of lows? And then could we take this high out this week and start to rally back up? And I think the answer is we know that we could. At the same time, could they try to rally this a little bit more and then fail? And then we're back down testing these lows. And that also could happen. And so I think right now, and again, remember, this is in accordance with the September price action history, right? So a lot of times September is a down month. And a lot of times it's volatile. So there could be a little dose of that. And that's why this is not easy. There's nothing that says we have to follow what September has done historically. But these historical tendencies and precedents do tend to matter. Not perfectly, of course, every year, but they do tend to matter. And in fact, the third year of the presidential cycle that we've been tracking has worked out, I think overall, it's worked out pretty well this year. So you really can't knock it when it's kind of kept you right overall in most weeks about your expectations, most months about your expectations. And right now that's telling us it's going to be bumpy for the next, say, 6 to 7 weeks. And then things start to really stabilize and start to improve as the year ends. So this sort of betwixt and between theme of the week is here in the financials, which are an important sector. It's there in real estate, which this is mainly commercial. That's also obviously not really a great trader. But in the situation that we're in currently, that could be an important sector, as would XHBB. But you also have the former leaders, which have been XLK, the technology sector over here, and you have the XLC, which was also a leader. And they really had help pull the market up a lot. Well, those are right now, the way that last week finished, we're also lower than that high at where we closed. That high is lower than these highs. And then these lows are where we swung from, and we're above those. So we're just really waiting, I think, for the market to try to break one way or the other, knowing that either a break or up or down could end up being a false breakup, but it could be legitimate. Right. So it's just a tough juncture where you can't say that, oh, no, here's why this is going to probably end up being a tradable low that lasts for a lot longer and leads to new highs. And I think that's because a lot of the market breadth indicators and other factors, mainly the dollar and the yields, are just not cooperative enough at the moment to say that. They're still, a lot of those things are concerning. And so because they're concerning, you need to just, I think, be nimble, right? And see what comes our way. We don't know what news will be coming our way, especially news that affects rates, affects yields. That's where it is. And a couple other things, right? As good as these could look, as good as energy does look, I think that's maybe honestly, not only is do I think that's probably related more to specifics of the energy situation right now, but I also think that's bad, right, for consumers, which are already feeling the pressure, as we talked about briefly in macro measure. So that doesn't help inflation as well. Even if they try to back it out, it's still a big part of life, regardless of what the government and the Praetorian media have to say about it. So it is what it is, and that's just a fact of life. And people need energy, and unfortunately, that is strongly trending still, and I don't think that helps. So rather than look at that as sort of indicative of a strong economy, I'm looking at that as saying partially that it's the economy holding together to this point. That's for sure. Give that the benefit of the doubt, but also it's the specifics of what's happening in relation to oil globally, et cetera. And so that looks good, but financials, they're a little concerning, right? That could turn into a problem quickly. Transports, which are another important sector for us, they're also, other than maybe being oversold, in the short run, maybe they're a little bit oversold. Those to me look concerning, right? That looks concerning that my transports have gotten rocked the way they have. So that's kind of lifeblood of the economy, products moving through the economy. And that looks concerning. And that could be, we've been talking about maybe another leg lower, risk off leg. That almost seems like one may be starting to develop there. And you might have a lot more selling, maybe, right? But the other thing would be, what's the story on the basic materials and what about the industrials? And you can see that those are also a little concerning, right? Where you could very easily break lows in XLI. That would bring about more selling, more than likely technical selling. There's gaps to fill down there. XLB, lower high put in, kind of feeble rally attempt there on Friday. They can't do much more with it, and this starts to roll over again. It won't be long before you're at that key level there near 80, and then you could start to again trade down and fill a gap. And just remember that a lot can happen in nearly 4 months that remain in this year. You could have an entire corrective leg, and they could still then repair a lot of damage by the end of the year, because they'll be able to then use, right? If you have an ugly September, they'll be able to use October, November, and December in the way that they typically do, which is to try to mark stocks up. Those are typically good months and on balance, and they might do it even more so, right? Because they're moving stocks back up from stocks being quote unquote on sale. So it is what it is that way. Now, in terms of looking at something like XLP versus XLY, we normally look at those and say, okay, what's looking like in favor, out of favor? That's interesting too, because the staples are really on the ropes, have been on the ropes. Sure, discretionary sold off, but discretionary has hung in there better. So in a way, what they're saying is, right, it comes down to each individual component, naturally, if you want to drill down into all that, but just in a general way, discretionary holding up is a little bit more bullish in my mind for the market than staples, because this would be defensive. If they were going after staples and selling this, that would tell me that there's more worry over the economy. Now, naturally, that could happen, of course, this week, but overall, right, that is not the case at the moment. So we're just looking at the here and now, and that's why, to me, like things are really unsettled right now, right? Yet to be determined. That's why I'm sticking with, and you could even look across the board here, and most of these sectors are somewhere in the 40s and 50s, with the exception of transports and staples, right? Almost everything else is in the 40s or 50s or close to it. So you're not really oversold, excuse me, where we could say, oh no, this stuff's a buy because it got rocked, it's bombed out. Is it a sale yet? Maybe, we don't know, but I mean, it's holding above the recent lows in a lot of cases. So again, I think you're betwixt and between. I hate to come to that conclusion because I know that a lot of folks are always looking for some kind of a lean, and the sector situation video really emerged from our desire to want to share what we try to do, and mainly it was in bull market. It started out in a mindset in our minds anyway, or a mindset was that we were going to show really what was emerging, right? Like what stocks, what sectors were lagging, what were leading, what could be emerging for our next series of momentum trades, or right, hopefully UOA plus momentum. We always like to have the UOA component if we can get it, and that happens a lot. But because this market has been what it's been, we have not really had that easier bull market type activity where you're pretty convinced that, hey, we're probably in a new bull, and let's trade this according to that sort of tried and true game plan. And these leadership areas still look pretty good. They've got room to run, but also this is now starting to perk up. And we had that happen a little bit earlier this year in certain sectors where we caught some laggards that were just left behind that began to participate. But right now we're not at that juncture. Right now we're at a juncture where it's still unsettled. So we have to wait for more data. That's just where we are. I've said this many times, and I've said it even earlier today when I was recording Macro Measure. And usually when I try to find a lean to come up with, right, for everyone, to share with everyone, to try to tell them where I'm coming from, because that's really what is folks demand. Most of the time when I have such a hard time, it's the right answer, in the sense that you needed to wait it out a little bit longer. So I still think, right, as of now, until you say break down below a key support level, like in SMH we happen to be looking at right now, if we were to break below, let's say 148 ish, that would be a problem in my mind. It would start to become a bigger problem potentially, right? And that would be the reason for that would be, here's your highest high. You have this, you lose the support of this upper support line. You blast through there, come down to this larger channel that we're operating in, and you can kind of trace that out with your eye. You find support at the lower end of the channel, right above the 100 SMA in dash white. You try to rally back through into this other area, right, the higher area of the channel, the other half, if you will, upper half, and you fail there, you get rejected back down. You fail again, you get rejected back down. And so if you have two really attempts to rally through and back into the upper half of the channel, and you fail, and you're now further away from your high, right, you couldn't get anywhere close to that, and now you roll over through support, that to me is a problem. And that means you probably are really close to having another leg lower. And that, again, I talked about that in Macro Measure, and that could be a gap fill situation. But there's just no way to, I felt like this sector is so important, I wanted to discuss it in Macro Measure as well. But that's the thing, like this trend that we've seen, and remember, this is a leadership area, and this trend that we've seen, you can see that the semis bottom, when the market bottom, and they really took off and have gone. They've been a leader, and it makes sense, right, overall to us, I think, why they would be. And now, right, they're not done yet. We can't say they are. You've got these longer term SMAs, the 100, 150, 200 respectively, and purple is the final one. Those are all still upsloping. So you can't say, well, this thing's toast, right? Because it could just be consolidating after a nice run. And once again, right, you might end up where you troll along here for a while and they lift it back up and it's go, go, go again. Could be. I'm not saying that, just saying could be. But you are really at this point closer to a critical juncture to the downside. I think the first big area to the upside would be that recent high, and that would be kind of finally get through and work its way back towards the upper half of the channel. And if it doesn't, again, that is more problematic, that it failed again for a third time. But as of now, yeah, this is your area. Still, even if you did crack that, this swing low, which is near 143.35, and the 100-day, which is at 144.65. So 143, 144 probably becomes a big deal. And if there's not a lot of support below there, so if they lose that in a big way, that's when you start entertaining this thing could really finally trade down in another kind of risk off leg that would develop in the market. But if you look at this one, 161.17 on the high, the low, as we said, was 143.35. So let's just ballpark it at $20. If this thing were to break from here, this would be 148 ish. I'm sorry, is that, yeah, 148 ish. So what's the high there? 157. So yeah, you would probably trade down, I would say, to about 137, just as a general guideline, right? Where you have a whole nother leg, including this part here, that's already unfolded, and you trade down towards that 150 SMA. And that does put you within striking distance if they really want to get that capitulation, right, to go down and close that gap. You still have quite a ways to go, but let's face it, when things usually develop that poorly, that's when sometimes you do get that extra, just get me the hell out. And hey, then you finally have that capitulatory selling. And then you finally see some bottoming action. They start moving it back up, usually at least attempt to. But that's an important sector, which is why I reviewed it. I want to get back to XLRE, and then we'll take a look at XHB. So this is a big deal of a sector, if you ask me as well, because right, this is your commercial real estate, and with more places being vacant, with a lot of issues cropping up on Main Street with consumers. We showed some stuff in Macro Measure on that, right? Just people are piling on the credit card debt, and people's savings rates getting crushed, and rates on credit cards are very high. It's nightmarish scenario potentially that's unfolding there. And so notice that this just did not participate in a big way in the rally, right? So if we look at this overall, they bounced this from 33 when the market kind of hit its bottoms in Oct. They took it all the way up to near 42 and change. So notice, right, that you're a lot closer right now to the lowest low than you are that high. And so this is not a sector that's participated very well, right, in the market's fun and games that they've had. So there's that, to me, tells me, right, that people are shying away from it. They're not willing to add. And that's probably because the risk that me, you, and every other Tom, Dick, and Jane perceive that could be there with, again, the problems that have been out there that have been really papered over, I guess, figuratively and literally in some ways, the way some people look at the paper money phenomena. You've got that happening for so long, right? Now you really don't get the cathartic side. They try to prevent that cathartic side of capitalism from happening, where things get cleaned up, right? The destructive side, where things get, well, wrecked, to use a modern word. And then you get that cathartic situation where it's all that negative stuff gets cleared out of the way. It's over and done. People take their beatings, and then you're maybe onto a healthier path as a result of that excess being taken out of the economy. They've tried to paper over that, so to speak, for, I guess, since my recollection really is since Greenspan. So that's, maybe people with longer market time will say, no, it was going on even before that. Maybe Nixon in the gold standard in 71. I couldn't say for sure, but the idea would be, of course, that you really can't have, we all know this, you can't really have the good without the bad of some things in a lot of life. And that's what we've tried to do without even really being willing parties to it. We've tried to do that as a country for so long. And that's why we're always at this great risk of things really unraveling, because we never really let things heal, in my opinion, in a simple way. Never let things heal in a realistic, normal way that needs to happen. So you foresaw the inevitable, but eventually that your luck's going to run out. When and where, I don't know. But getting back to this is, I think, the problem here, though, because everyone knows that, right, the things just really haven't bounced back, and a lot of people are done with the whole city experience. They're done with traveling to that corporate office. They don't want to be there as much. companies are treating it that way. The infamous WeWork was there were headlines made on that, I think, recently. You can go back and sort of see that as an exclamation point. So yeah, this thing never really participated. Housing, on the other hand, did, because they, I guess, really broke the final straw for some people in some states and localities, and people were just like Eddie Albert singing Green Acres, and saying, let me get out of here. I don't want to be in around all this concrete and asphalt. I want to be where there's green acres. So a lot of people have migrated to where they want to live, and they're trying to do the remote work thing, and hopefully that works out well for them. But the point is, right, that has really helped a lot of players that are home builders. Yet, right, these rates may finally, the fact that rates have risen so much may finally be starting to, I guess, impact, right, this market. And so this thing is still hanging in there, and it blows my mind that it's been able to do it for this long. But that's really nothing new. I'm always way early, which is, again, just another reason why I never trade my take on things. But there could be, of course, risk here if they just refuse to bring rates down, and rates even worse, rates continue to go up. But that is still intact. So that's really where there's this big separation, I think, between commercial and these home builders. It's just a different story, and they're still holding together overall. I mean, even I think we had a bearish trade on it. We did get some downside out of it, I think. But notice, right, last week, or really the prior week's Friday, the prior week, they were able to get it not too far from the all-time high, despite everything, which again kind of is mind-boggling to me, but it is what it is, right? This is a great example of why you got to really wait for the technicals to set up, and how another great example of how hard it is to counter trend trade, right? Even if you've got great, you think, justification for it, these guys like were relentless and flushing folks out that were trading against this long. They flushed those people out, they reversed it strongly, and then they're merciless for the next 5 sessions, right, all the way up in your face, and inexplicably, and you're like, this is utter madness. But unfortunately, if you were short and stayed short, you had to live through that until, again, finally reality started maybe creeping back in. But this, to me, still intact, but this is getting closer to being on the ropes, right? So you take those lows out, you get the lower high that gets put in there, take out this recent low. If that happens, you're revisiting these. That could be a problem. But again, the trend still has yet to be broken there. So I don't know if you trade it too big too quickly. We did take a look at SMH. Let's take a look at some of the lumber related ETFs, the wood and the cut. Not really that impressive, right? Don't want to belabor this, but look, that's not really that impressive. So falling below all the SMAs again, it's obviously sideways-ish action, right? Consolidation is really what's been going on in these things. And so that real flurry that we saw of, again, green acres, give me those green acres, that really seems to have cooled off. I wouldn't say subsided, but cooled off a little bit, certainly from its peak, and not really a great look in this chart. So these are messy, right? These certainly need to be sorted out more. While we're here, let's take a look at copper while we're here and see if that's telling us anything about the global economy. And we don't know because we're looking at March. Well, come on, Thinkorswim. Let me see the present day. And that's not a good look either, right? That's rolling over with lower high put in below all the SMAs. So again, kind of like, hey, it's not hard. This is why I'm getting a little worried. I think we ought to see more corrective activities. That's what my kind of like common sense way of looking at it is. But right, that wall of worry, higher rates, slowing, this, that, and everyone knows that, and that wall of worry is what these fiends prey upon, right? If you're too early and you fight too aggressively against them. So you've got to be smart. But this is not really a great look. And clearly the oil situation, again, I'm just going to continue to reiterate that this is its own thing most of the time anyway. but it's certainly right its own thing with all the news that's been out there now. So look, this thing's been uptrending. It after it was struggling for a long time, really not that impressive. Now it's kind of gotten its swagger back a little bit. And so even though I think really now it's a little bit overbought on the daily and probably needs to back off small, you can't, if you look at this now, this is really what a trend change looks like, right? Excuse me. We went into this corrective phase back in the summer, excuse me, of 22. And then that ran its course really here almost to right the summer or right to about the summer of 23. And now, right, it's been trying to change trend with higher highs and higher lows getting put in. So if it maintains that by just backing off a little bit and goes again, right, it's going to keep looking more and more like the trend is up in there. And again, I think that's bad overall for consumers that are already squeezed, and certainly it's not going to help inflation because excuse me, oil and oil byproducts are such a big part of everything. Thinkorswim's getting me on the percentages, but excuse me, I'm trying to clear my throat from allergy issues. But we have again another look at XLE since we looked at that future, and that's very right, not in lockstep, but it's very similar to what we saw. And so could this, of course, get more stretched? There's no question. But I think right now it's a little bit overbought. It's obviously it's news driven at the moment. It's not too far, excuse me, from the highest high. It's almost back there, but the trend is up for now, and it's just short-term overbought. So if you're riding longs, you really want to, I think, watch out right now because this move is not stale. It's just that they might try to sprinkle a little corrective activity in there in the absence of news to propel it. So it's just maybe due for a little bit of a pullback. And then if it puts a higher low in, holds those rising SMAs that you see there, then white and light blue, the 10 and 20 respectively, you're probably good to go and expect, again, I would just stick with the trend and expect the trend to potentially continue. Let's look at metals. And I think this has been an interesting area. And we said this, I mentioned a few weeks ago that looking at XAU, that I wasn't really a long-term bull yet. And I kind of hope to be right instead of hope to be wrong. Usually when I say things, I'll add, I hope to be wrong. But in this case, because I'm a little selfish on this one, I really want to buy more of what I've got at a lower level. I will really want to DCA my way into more quantity and at lower cost basis. So I said I didn't completely buy what we were seeing. We were seeing UOA that was bullish ostensibly. I did think there was a chance for a quick pop, and we didn't get triggers. I don't think we got triggers. Things did not materialize. So I'm not taking a victory lap here. I'm just noting that I'm glad that it worked out the way that it did because it did not trigger. And so no one really should have gotten involved in those ideas, which is good. And then secondly, right, we might be getting a chance, if with a little bit more weakness, we could get a chance that maybe this gap closes down here. And this would be great for people like me and other people that want to hedge themselves more with metals for the long term. And so if you're wondering, well, why would this be happening? Remember that the dollar and these usually have a pretty strong inverse relationship. And as I type XAU, I'm sorry, I typed DXY, but it didn't take it. Here's your DXY. You'll see what I mean. I don't want to have to, but you can see like right, precious metals XAU has been struggling. You can see the dollar has been doing better. I'm thinking Dr. Copper, I guess, in the back of my mind, as they call it. But you could see, right, that it's pretty inverse overall. That's the funny thing, though, because I think even the dollar's a little sort of overbought as short term. So it could be a little noisy in both of those areas, I think. But the trend here is maybe changing, right? And that the dollar's trend was was down, and now it's trying to really take out highs and put in higher lows, generally speaking. So the intermediate term has been up. It's you got to pay attention to something when it cruises through a high. This next high would be important, right? To get through and maybe trade up to 106 and hold above there, hold above that 105 and change at that point. That would be big. That would start to tell you that maybe this thing really does have legs that could keep going. And I think that would be really bad for equities, and it would be bad for probably gold as well. So just keep that in mind. But I'm trying to think if there's anything else I can look at in depth. We looked at SMH. We looked at a lot of different things. We think about it. Is there one more thing I could take a look at for us? And just go back to this grid and see if there's anything that I really feel like when I looked at things earlier, they really are popping out to me. I think it might be worth taking a look at this XTN, because I consider that an important sector. And I'm just old school, I guess, but to me, this is very important, and this is not acting well. This is really on the verge of far worse things if it gets knocked below that 200 in purple. And that's not that far away. That's only 2% away. There's a gap there that I've got a little highlight on. Probably if we looked further back in time, we'd find others, but this is maybe the most relevant one right now. You could say, well, that's only going to be down like 3 points from there, but really, yes, but at the same time, that is going to look visually like a pretty large drop visually. And so that's what we're really looking at here. And so this is not a good look, is it? Right? With your short terms moving SMAs rolling over, the 50 is on the cusp of rolling over there in gold. Long terms are flattening out. And you've got this lower high relative to here put in. You've got this low, which corresponds to this one over here, but now you've got a lower low than that, right? So this is really on the verge of bad stuff. And that to me is not really a good sign for the economy. And that is one thing that if I could say, oh, this is the key piece I needed to see. Somehow though, financials are hanging in there, right? I can't say that just, hey, the transports alone, they could be having difficulty with fuel costs. There's all kinds of things that could be part of it. But if the financials start to roll over and you've got XTN rolling over as it has, and things continue to worsen, this breaks down. Certainly if XLF breaks below the 100 SMA, which on my chart right here should be 33.59. So about 90 cents. I'm sorry, not 90. What am I saying? About 70 cents down from here would be the one. That would be where the 100 is. Again, not a big mover, but it's just the fact that what are these things doing? And I think you have to be concerned about that, because again, another important sector is money moving through the economy? Are goods moving through the economy in a way that these companies are set to fare well, or at least something that is indicative of a healthy, maybe growing economy? I don't think that's the case. As I showed in macro measure, there's even the St. Louis Fed is having to come to terms with the fact that maybe the third quarter GDP could be negative, small. That doesn't mean that stocks go down, of course, because we know that these guys are going to pull out every trick in the book to keep those EPS elevated. But the point is that there's issues here for sure in this economy at the moment, and they might be able to get away with this for a little bit longer. But if this doesn't start to turn around, or the Fed, the worst thing, as we've seen in the past, would be, right, that if the Fed goes up and then quickly they're cutting, maybe after they go up in November, early November, then quickly they're cutting shortly thereafter, that would not be a good sign. You probably are then going to have a real ugly market phase. Probably it would kind of go counter to end of third year, fourth year of the cycle. But then somewhere really in that sort of chaos and capitulation, somewhere around 6 months after the Fed starts cutting, you probably wanted to put some money to work, even if you don't think there's a bottom, just because you never know. And you can start DCAing a little bit on that. But I think I'm going to wrap on that. There's anything else that comes to mind that I think is worth really highlighting. Probably went a little longer than I expected to anyway for sector situation. But again, excuse me, I'm just trying to help out where I can. Not an easy week coming up. That's what September really should be. That's what we've been expecting. Even October, especially early on, should be this way. So we'll see. I think keep your eye on the dollar, keep your eye on TNX, and keep your eye on these important sectors like XLF and XTN. And then that would also apply to the leadership sectors like XLK and XLC as well. And if those things start to falter, it's really then looking like another risk off leg, right? And you're close to that because all it would take, there's good things on these charts and there's bad things on these charts right now. And all it would take, this could very easily flip bullish in a big way, but all it would take to flip bearish would be revisiting this 356-ish level, which is the 100-day on the Qs. And so you could say, well, that's not going to happen this week. You're probably right. It probably won't happen this week, but it could. There have been weeks where you do get that kind of forceful selling, but it could happen after the Fed next week if they don't like what happens there too. Just keep that in mind, because next week I think is Fed week. Not this coming week, but the following week is Fed week. And we also do have big data coming out this Wednesday and Thursday, maybe Friday, but definitely Thursday I know of for this week with PPI, the CPI, PPI, and some other retail sales, jobs numbers, things like that are coming out that could be impactful right in front of the Fed. So again, I think it's time to be nimble. Let the market tell you what to do. The sectors that are sticking out, we talked about, you just don't want to see much more deterioration in these things. So maybe we won't see it, maybe we will. But if you do, that could be the clue that not only are the sectors worsening, breadth would probably be worsening at that point. And if that's happening, that might be right the setup for you're right for that second leg of risk off to develop, like we saw really happen in July. Maybe you start getting that in the second half into October, and then maybe the gang pulls their pulls off the typical end of year celebratory shenanigans. But don't want to get too far ahead of ourselves. So I hope something I've shared with you today helps you out in this week, or excuse me, some week in the future. Thanks again for tuning in, and I will see everybody through the updates and webinars and so forth that we conduct throughout the week. Stay nimble out there. Thank you.